Welcome back to the Daily Crypto Deep Dive. The crypto market is approaching one of those moments where two powerful forces collide. On one side, Michael Saylor has just added another $1.57 billion worth of Bitcoin to Strategy's growing treasury. It's one of the largest institutional Bitcoin purchases in recent months, and it reinforces a message Saylor has repeated for years. Bitcoin is digital property, and institutions that fail to accumulate it will eventually regret it. But at the same time, another story is unfolding beneath the surface of the market. Traders are warning that nearly $2 billion worth of leveraged positions could be liquidated if Bitcoin loses a key support level. That means the market is now sitting on a fragile line between two opposing forces: institutional accumulation on one side, and highly leveraged traders on the other. When those two forces collide, crypto markets tend to move quickly, sometimes violently. And today we're going to break down exactly what this situation means for the crypto market, what it means for Bitcoin, what it means for altcoins like Ethereum, XRP, Solana, and Cardano, and most importantly, what it means for investors who are simply holding their coins and trying to understand where the market could move next. Because if history tells us anything about these moments, it's that the outcome can reshape the market in ways very few people expect. To understand the situation properly, we need to start with Michael Saylor. Saylor has become one of the most recognizable figures in the crypto industry. As the co-founder and executive chairman of Strategy, formerly known as MicroStrategy, he has overseen one of the most aggressive Bitcoin accumulation strategies in corporate history. Years ago, Strategy made the decision to convert a large portion of its corporate treasury into Bitcoin. At the time, many critics dismissed the move as reckless. Bitcoin was volatile. Institutional adoption was still in its early stages, and many traditional investors viewed the asset as little more than speculative digital gold. But Saylor had a different view. He believed that Bitcoin represented a new form of digital property, something that could store value across decades and even centuries. And more importantly, he believed that inflation and monetary expansion would gradually erode the purchasing power of traditional currencies. In that environment, Saylor argued, companies needed a new type of treasury asset. Bitcoin, he believed, was the answer. Over the years, Strategy continued to accumulate Bitcoin through multiple market cycles. Even during major crashes, the company maintained its conviction. Now, with the latest purchase worth $1.57 billion, Strategy has once again doubled down on that strategy. For many analysts, this move sends a powerful signal. It suggests that institutional conviction in Bitcoin remains strong even during periods of uncertainty in the market. And it reinforces the idea that large players are willing to buy when prices pull back rather than waiting for the next rally. But while this institutional buying story grabs headlines, another dynamic is developing inside the derivatives market. Crypto markets today are heavily influenced by leverage. Leverage allows traders to control large positions with relatively small amounts of capital. A trader might deposit a few $1,000s and open a position worth tens of thousands. If the market moves in their favor, profits can multiply quickly. But the opposite is also true. If the market moves against them, losses can escalate just as rapidly. And when losses reach a certain threshold, exchanges automatically close those positions. This process is called liquidation. Liquidations are one of the defining characteristics of modern crypto markets. When they occur in large numbers, they can trigger rapid price movements that ripple across the entire ecosystem. And right now, analysts are warning that roughly $2 billion worth of long positions could be liquidated if Bitcoin falls below certain support levels. That means the market is sitting on a large cluster of leveraged bets. If Bitcoin continues to hold its support, those positions may remain stable. But if the price drops even slightly below key thresholds, a wave of liquidations could begin. When liquidation cascades start, they can create a chain reaction. The first liquidations push prices down. Those price drops trigger more liquidations. And those liquidations push prices even lower. In extreme cases, this cascade can wipe billions of dollars from the market within hours. This is why experienced crypto traders often watch liquidation data closely. It provides insight into where leverage is concentrated and where the market might experience sudden volatility. But the most interesting aspect of the current situation is how this liquidation risk intersects with institutional accumulation. On one side of the market, you have traders using leverage to speculate on short-term price movements. On the other side, you have institutions buying Bitcoin with long-term horizons measured in years or even decades. These two types of market participants behave very differently. Leveraged traders are sensitive to short-term price movements. Institutions tend to focus on long-term trends. When these two groups collide, the result can produce powerful market movements. If a liquidation cascade begins, institutions may step in and absorb the selling pressure. That can lead to what analysts sometimes describe as a liquidity sweep, where weak hands are forced out of the market while stronger investors accumulate more coins. This dynamic has appeared multiple times in Bitcoin's history. Sharp corrections driven by leverage often end with stronger market structures because the excessive speculation has been removed. For long-term investors, this process can actually strengthen the market. But to understand the full picture, we also need to consider what analysts are saying about the current cycle. According to Bitwise CIO Matt Hoogan, one of the most interesting developments in the current crypto market is how institutions behaved during recent corrections. When Bitcoin experienced a major drop, Hoogan noted that many institutional investors did not panic. Instead of selling, they held their positions. Some even added to them. This behavior contrasts sharply with earlier market cycles, when price drops often triggered widespread selling across the entire ecosystem. Today, the presence of institutional investors may be changing how the market reacts to volatility. Institutions tend to view Bitcoin through a different lens than retail traders. Rather than focusing on short-term price swings, they often evaluate macroeconomic trends. Inflation, monetary policy, global liquidity, currency debasement. From that perspective, Bitcoin represents something more than a speculative asset. It represents a potential hedge against the long-term instability of fiat currencies. This shift in mindset may be one of the most important developments in the crypto market over the past decade. But what does all of this mean for the broader crypto ecosystem? To answer that question, we need to look beyond Bitcoin itself. Bitcoin still acts as the gravitational center of the crypto market. When Bitcoin moves strongly in either direction, the rest of the market tends to follow. This relationship is often described through Bitcoin dominance, the percentage of the total crypto market capitalization represented by Bitcoin. When Bitcoin dominance rises, it usually means capital is flowing into Bitcoin faster than altcoins. When dominance falls, it often indicates that investors are rotating into altcoins. In the current environment, Bitcoin's behavior could determine the trajectory of the entire market. If Bitcoin holds its support and continues rising, altcoins may follow. If Bitcoin experiences a liquidation cascade, altcoins could fall even faster. This is because altcoins tend to amplify Bitcoin's moves. They rise faster during rallies, but they also fall faster during corrections. Ethereum, for example, often behaves like a high beta version of Bitcoin. When Bitcoin rallies, Ethereum tends to outperform, but during sharp sell-offs, Ethereum can drop more quickly. Solana and other high-growth blockchain ecosystems often exhibit even more volatility. But one of the most interesting cases in the market right now is XRP. XRP has developed its own narrative within the crypto ecosystem. While many cryptocurrencies focus on decentralized finance, smart contracts, or blockchain infrastructure, XRP has long been positioned as a tool for cross-border payments and financial settlement. The token has also been at the center of one of the most closely watched regulatory battles in crypto history. Ripple's legal fight with the United States Securities and Exchange Commission has shaped the perception of XRP for years. Now, as regulatory clarity slowly improves in the United States, many analysts believe XRP could benefit from renewed institutional interest. But like all altcoins, XRP still remains influenced by Bitcoin's price movements. If Bitcoin experiences a sharp liquidation cascade, XRP would likely feel the impact. However, if Bitcoin stabilizes and institutional accumulation continues, XRP could benefit from broader market confidence. Some analysts believe that the next phase of the crypto cycle may involve capital rotating from Bitcoin into large-cap altcoins. Historically, this pattern has appeared in several bull markets. Bitcoin rallies first, then Ethereum, then the rest of the altcoin market. Whether that pattern repeats this cycle remains uncertain, but the conditions for it are beginning to take shape. One factor that analysts are watching closely is liquidity. Liquidity is one of the most powerful drivers of financial markets. When liquidity increases, when more capital flows into markets, asset prices tend to rise. When liquidity tightens, markets often struggle. In the crypto ecosystem, liquidity can come from many sources: institutional investors, retail investors, exchange-traded funds, stablecoin issuance, and global macroeconomic conditions. If institutional demand for Bitcoin continues rising, it could gradually increase liquidity across the entire crypto ecosystem. That liquidity could eventually flow into altcoins. But the short-term path of the market may still depend on how the current liquidation risk plays out. If Bitcoin holds its support levels and absorbs the leveraged positions, the market could stabilize quickly. If the support breaks, we may see a short but intense period of volatility. And for many long-term investors, this is where perspective becomes important. Crypto markets have always been volatile. Large corrections have occurred in every major cycle. But over the long term, the market has continued evolving. More infrastructure, more institutional participation, more regulatory clarity, more global awareness. All of these factors suggest that the crypto ecosystem is gradually maturing. The battle between leveraged traders and institutional accumulation may simply be another chapter in that evolution. Right now, the market sits at a crossroads. Billions of dollars in institutional capital are entering Bitcoin. At the same time, billions of dollars in leveraged positions could still shake the market if key price levels break. Whether the next move is a sharp correction or a powerful rally may depend on how these forces interact over the coming days. But one thing is becoming increasingly clear. The crypto market is changing. It is no longer driven purely by retail speculation. Large institutions, hedge funds, and corporate treasuries are now part of the ecosystem. And that shift is transforming the structure of the market itself. The clash between institutional conviction and leveraged speculation may ultimately determine how this cycle unfolds. For investors holding Bitcoin, Ethereum, XRP, Solana, or other major cryptocurrencies, the key lesson is simple. Short-term volatility is often the price of long-term innovation. And in moments like this, when billions of dollars in capital collide with billions of dollars in leverage, the crypto market tends to remind everyone just how powerful those forces can be. So the question now becomes simple. Will institutional accumulation absorb the leverage and push the market higher? Or will a wave of liquidations shake the market before the next rally begins? The answer may arrive sooner than many people expect. And when it does, the entire crypto market will feel the impact. Drop your thoughts in the comments, smash like, follow, and as always, we will see you at the top.